Of all the numbers on a financial statement, earnings per share may be the single figure that investors watch most closely. It anchors analyst models, drives price-to-earnings multiples, and sits at the center of most executive compensation targets. That visibility makes it one of the most litigated areas of financial reporting. ASC 260, the earnings per share standard, exists to ensure that number is calculated consistently, disclosed fully, and never quietly inflated by ignoring shares that could dilute existing investors. By the end of this section, you will be able to calculate basic EPS, including the preferred dividend numerator adjustment. Apply the Treasury stock method to options and warrants in the diluted computation. Work through the if-converted method for convertible debt and convertible preferred. Identify when a security is antidilutive and why it is excluded, and explain the full presentation and disclosure framework required by ASC 260. EPS is the number that shows up on financial news tickers when results are announced. Missing analyst consensus by a penny triggers shareholder lawsuits. Beating it by 0.5% drives a rally, because so much rides on this number: valuations, executive pay, market reactions. The SEC scrutinizes EPS disclosures intensely. Understating dilution by excluding convertible instruments or misapplying the Treasury stock method is not a minor footnote error. It is an income statement misstatement, visible to every investor and analyst who reads the filing. ASC 260 applies to public entities and to any entity that has issued, or is in the process of issuing, common stock. For private companies with no plans to go public, EPS is optional, and many choose not to present it. But for public filers, presentation on the face of the income statement is mandatory and applies to every comparative period included in the filing. Entities with simple capital structures, meaning no dilutive instruments exist, may present a single EPS figure rather than separate basic and diluted amounts. Basic EPS begins with net income, but not all of net income belongs to common shareholders. Preferred shareholders have priority rights to dividends. For cumulative preferred stock, the dividend accrues every period whether or not it is declared. That amount is deducted from the numerator regardless of declaration. For non-cumulative preferred, the deduction is only taken if the board actually declares the dividend in the current period. And in consolidated statements, remember to use only the parent's attributable income. Non-controlling interest income is not available to the parent's common shareholders. The denominator is not the share count at year-end. It is the weighted average of shares outstanding across every day of the year. A share issuance on July 1 is outstanding for half the year, so it counts as half a share in the denominator. A stock split or stock dividend is different, because splits increase all shares proportionally without changing value. They are applied retroactively to every period presented as if they occurred at the beginning of the earliest period shown. Treasury shares are excluded because the entity holds them. They are not in investors' hands and should not dilute the per share amount. Diluted EPS answers a hypothetical question. If every instrument that could be converted into common shares actually were converted today, what would EPS look like? The standard requires assuming the most dilutive possible outcome, conversion at the beginning of the period, not at period end. For each potentially dilutive security, you adjust both the numerator and the denominator to reflect what income and share count would be if conversion had already happened. The key filter: only include a security if including it actually reduces EPS. If it would increase EPS, it is antidilutive and gets excluded. The Treasury stock method is the required approach for options and warrants. The mechanics: assume all in-the-money options are exercised at the start of the period. That produces a cash inflow equal to the number of options times the exercise price. Next, assume the entity uses that cash to repurchase shares at the average market price during the period. The net dilution is only the additional shares that cannot be repurchased, shares issued minus shares bought back. When the exercise price exceeds the average market price, the options are out of the money and antidilutive. They are excluded entirely. Convertible debt presents a different calculation. The if-converted method assumes the debt was exchanged for common shares at the start of the period. Two adjustments follow. The numerator increases because the interest expense that would have been paid on the debt is no longer paid. Add it back net of the tax benefit that interest would have generated. The denominator increases by the shares the debt converts into. Before including the security, calculate the incremental EPS, the numerator add-back divided by the additional shares. If that incremental rate is below basic EPS, the security is dilutive and gets included. Convertible preferred follows the same if-converted logic as convertible debt, with one important difference. Preferred dividends are not deductible for tax purposes, so there is no tax adjustment to the numerator add-back. The mechanics: assume conversion at the start of the period, add back to the numerator the preferred dividends that were originally deducted in the basic EPS calculation, and add to the denominator the common shares the preferred would convert into. Contingently issuable shares, shares that will be issued when certain conditions are met, are also included in diluted EPS if all conditions are already satisfied at the balance sheet date. Diluted EPS is supposed to show the worst case, the maximum dilution. Including a security that would reduce that dilution contradicts the purpose of the calculation. An out-of-the-money option is antidilutive. Exercising it would generate so much cash for share repurchases under the Treasury stock method that the net effect would be fewer shares outstanding, not more. These securities are excluded from the diluted computation. But they must be disclosed in the notes, the quantity of excluded shares and the type of instrument. Analysts need that information to model future dilution if market prices move. The presentation obligations under a ASC 260 are specific. Basic and diluted EPS must appear on the face of the income statement, not buried in a note, for both income from continuing operations and net income. When discontinued operations exist, EPS for that component is derived on the face as well. For comparative periods, retroactive adjustment applies whenever there is a stock split, reverse split, or stock dividend, as if the new share count existed throughout all periods shown. The accompanying notes must reconcile the numerators and denominators from basic to diluted EPS, and separately disclose antidilutive shares excluded from the diluted computation. EPS is more than a single number. It is a structured calculation with clear rules about numerator adjustments, denominator weighting, and how potential dilution must be reflected. Basic EPS accounts for preferred dividend rights and time-weights the share count. Diluted EPS applies the Treasury stock method to options and the if-converted method to convertible instruments, including only those that genuinely reduce the per-share result. Antidilutive securities stay out of the calculation but must be disclosed, and every stock split or dividend triggers retroactive restatement across all comparative periods. Thank you for completing this section on earnings per share.